I do believe the next decade will belong to India if it plays its cards right. I've talked to a lot of Indian business people, and they come back from China so impressed that everything is working so well that they want something changed. The government can do it in a step. To be careful what you wish for. Greed and short term comes more naturally to us. It's not going to go away. My concern with the Indian market is it's been too good for too long. The rates of depression have increased, especially among young people. 15 years from now, we'll look back and say, I wish we hadn't done that. That's a very real possibility. But I don't see how you stop this train. It's on the tracks already. My rule in investing is I get Indian parents sometimes call me and ask me to talk to their kids about why they should go to business. And I said, well, why would I do that? Because maybe they shouldn't go to business.
Welcome to the India Opportunity Podcast. Hello and welcome everyone to the India Opportunity Show. Today we are joined by a true pioneer in the world of finance, a man whose insights into valuation have shaped the way we understand and approach investing across the globe. Professor Aswath Damodaran, often called the Dean of Valuation, has built a reputation not just as a scholar but as a practical guide for investors, CEOs, and market enthusiasts. With decades of experience at NYU Stern School of Business, he has truly demystified the art and science of valuation with his work that bridges rigorous data with real-world insights. So thrilled to have him here with us today. Hope you enjoy watching. Good morning, Professor. Welcome. It's an honor to have you with us today. Welcome to the show. How are you doing?
Thank you for having me. Good morning. It's good morning for me, but I'm sure it's evening for you.
Yeah.
Good morning to you.
Professor, Swiggy's IPO is opening tomorrow in India, and I would love to start with that, given you were so vocal about Zomato's IPO. There's a lot of buzz around the company, and the question on everyone's mind is whether to buy or not. Given Swiggy's current metrics, what would your approach be in assessing its valuation? And are there broader lessons here for retail investors navigating such IPOs?
I'm not sure I was that vocal. I was curious about the Zomato IPO. I wrote about it, but to be quite honest, I haven't thought much about it since. I mean, I'm a dabbler. I tend to think about things that are interesting, then I move on. So Zomato is not the center of my universe. I've never actually used Zomato to order food, partly because I can't do it here. But I think that that with Swiggy, I would look at the same determinants. Swiggy is a joint bet on India's growth as a country. Because let's face it, without India growing into its income, restaurants will not be able to make money. And without restaurants, you will not get restaurant delivery. So this whole chain of things have to happen. It's a joint bet on India's growth. The propensity of Indians to eat out, which has increased over time, but it'll continue to increase, and what the delivery business will look like in terms of regulation, technology, etc. So when you make those bets, you got to be clear about the bets you're making. This is true not just for Swiggy, but for every company you invest in. Be clear about what you're betting on. And you're not betting just on the company, you're betting on a country, you're betting on a culture changing. And all of those things will play out in what you're willing to pay for Swiggy.
Yeah, absolutely. And just any thoughts around the quick commerce business? Because what has happened in the Zomato stock, I think we've all seen that Blinkit's acquisition for $500 million now has resulted so successfully for them. So what thoughts about Swiggy and Instamart?
I'll be quite honest. I'm never quite sure what to make of words that emerge. I'm not sure, for instance, what quick commerce is or last mile is, but I'll give you why I think Zomato has done so much better in the market than I expected. I was in India a couple of months ago, and one of the things I noticed, I was in Chennai, but I'm sure this is true in Mumbai or Delhi, is how incredibly time consuming it is to run even what should have been the quickest errand, something a mile away, something that you'd have driven out to in 5 minutes, picked up your laundry and come back. You're looking at maybe an hour because of the traffic, because of finding parking, and all of the related issues. In many ways, Zomato is arbitraging that logistics problem in India. And Swiggy might be able to as well if they can scale up. The Blinkit acquisition gave them an opening, but I think this is an opening that exists for lots of companies. Here's how it works out. You're an Indian professional. You work all day. You come back from work at 7, 8. Put in whatever time you come back from. You pull into your driveway in your motorcycle, your car, whatever it is. You go up to your living room and say, "Oh my God, I forgot to pick up whatever." And then you think about going out to pick it up, and your stomach drops because you realize that's going to take up the bulk of the rest of your evening.
Yeah.
What Zomato is doing is inserting itself in that space, saying, "Hey, you know what? You want your laundry picked up? We'll do it for you." And what it's benefiting from is if you look across Indians, the value that they put on their own time has a huge variation.
Yeah.
I'll wager you walk out there, you talk to and you talk to people on the street. There are some people who might value their time at 100 times more than you do, or 100th of what you do. What Zomato and Swiggy are taking advantage of is that time arbitrage. And essentially, they're saying you value your time at $50. That person values their time at 50 cents. They will do things for you with their time that you would never be willing to. I wouldn't be surprised. It might already be happening. A new Avengers movie opens up, or a new movie you want to see opens up. There's a long line to buy tickets. You don't want to go wait in that line because you value your time, for better or worse, at a high number. Zomato says, we'll hire somebody to stand, or Swiggy says, we'll hire somebody to stand in that line for you. You pay us X dollars. It might sound like a lot to pay somebody, but relative to your time. So I think with both Zomato and Swiggy, that's something to factor in, is the infrastructure problems in urban India. I mean, India's done a lot in terms of infrastructure outside the urban areas. I like the highway systems. I think it's a big investment that's paid off. But the cities are a complete infrastructure mess, and it's not fixable. It's not fixable with reasonable amounts of money because the city's already been built. You can't, widen the streets without creating chaos. So I think both with Zomato and Swiggy, I would say look past the current numbers. You're not buying the last year's financial statement. There's not much there. For either Zomato or Swiggy, you're buying potential. You're buying the expectation that the infrastructure problem in India is not going to go away and that these companies will be able to leverage themselves up to be the first movers in this business.
Yeah.
No. And the advantage they have is they already have a platform, they already have the people working for them. It's just an extension of, instead of going, asking their drivers to go pick up food from a restaurant, they ask them to go pick up laundry from a laundromat. So it's an extension of their business model. So with Swiggy, I wouldn't be surprised if that gets priced in, even if they're not able to do it. And Blinkit is not the magic that opened it up. It allowed them to do it, but I have a feeling that they'd have got there eventually. Blinkit just speeded up the process.
Yeah, absolutely. Those are very interesting insights. But when you think about these consumer tech businesses at large, what premium would you put on the intangibles such as the brand? Because I think Zomato's IPO was a very big signal to the Indian market because of the consumer brand pull that it's been able to create. And Swiggy has a big cult as well of consumers that really believe in the brand story. And also there's significant retail participation, which is happening in Indian equities now. So how should we value the brand and intangibles?
I don't want to be facetious, but have you ever tried paying for lunch with intangibles or a house with intangibles? Ultimately, for intangibles to have value, they have to show up in the numbers. The reason accountants may have this fixation about intangibles is they're balance sheet focused. And the reality is, and they're right, balance sheets have historically been tilted towards things you can do: land, building, equipment, machinery. So balance sheets have been very poor receptacles for intangibles because accountants have no imagination. I hate to insult accountants. Actually, I do like to insult them, but so I'll act like I hate to insult them. But they don't have the imagination to do it. In intrinsic valuation, the value of a business is driven by its cash flows, the growth in those cash flows, and the risk in those cash flows. That's it. It's true in every business. If you have an intangible and it'll never create cash flows, you know how much it's worth? Absolutely nothing. If you have an intangible that is going to create cash flows, it should be in your intrinsic valuation already. So, when you think about branding, how does it show up? That when you get on as a customer onto your apps, you're more likely to pick Zomato over another app because it's more reliable. You've used it before. which means it shows up as higher revenues. Maybe you're willing to pay a higher price for food from the same restaurant because you think this app will deliver better than the other app. I'm not sure that's true. But those are the questions that drive the value of intangibles. I mean, I wrote a piece on intangibles a few weeks ago looking at Nike, one of the legendary intangible companies out there. That swoosh is just one of the best recognized brand pictures of all time. You know how
Absolutely.
much money they paid to get the swoosh? $35. They were a small business. The designer came in and said, "What about this?" And they actually picked the swoosh accidentally. They paid $35 for it. And my point was, people act like intangibles are something you can plan for, that you spend enough money on it. Intangibles are often the result of a series of accidents along the way that build up to something that you can use now to either generate higher revenues, higher margins, higher cash flows, or reduce your risk. So with every intangible, that's what I force people to do. I'm saying, I'm not telling you intangibles don't have value, but it should be in there. Where is it in there? That's an exercise that's not just an intellectual exercise, but cuts the heart of investing. Because if you're investing in a brand name company and where it's showing up is higher margins, then you need to, as an investor, keep your eyes on the margins, because if your brand name is dissipating, that's where it's going to show up.
Absolutely. And how do you think about the current valuations that these companies are valued at? Because, there is a significant debate which is going on in India that Swiggy is listing at a significant discount compared to Zomato, given that they're at the same revenue, even though Swiggy is still loss making and Zomato is already profitable. So how does one think about that?
Are we talking about relative price? This has nothing
Yeah.
to do with valuation, right? It's no. Most of the people making these statements have never fully valued a company. They price companies. They use multiples of revenues, earnings, and when they say Swiggy trades at a discount, they're arguing that it trades at a lower pricing than
Yeah.
an otherwise similar company, with similar in quotes. Now, I think that to try to explain pricing differences again, you need to go back to basics. Basics are revenue growth, margins, reinvestment, and risk. So if the pricing difference is coming from a fundamental, and I think there are reasons to believe that Swiggy fundamentally has less attractive features on margins and reinvestment than Zomato does. No, then you could argue that it should trade at a lower multiple. But let's be very clear. Most of the time when people talk about valuation, they're really talking about pricing. And the difference between pricing and valuation is valuation, you have to understand business. I told you about thinking about the growth of the country. With pricing, you avoid all of those, but at a cost. It's sloppy. It's lazy. You're comparing one company to another. Say, this company looks cheap, and both could be overpriced by 50 or 80 or 100%. You're just finding the less overpriced stock. So if you ask me, should Swiggy trade at a lower multiple, I presume, of revenues, because that's the only positive number you have to scale up? It
Yeah.
should probably, because Zomato's further advanced in the life cycle, has shown that it can turn the corner from losses to profits. And Swiggy hasn't done that yet.
Would you buy either of the companies?
I'll be quite honest. Buying an Indian stock for me is a reach now, and I'll explain why. It's not that I don't buy into the India story. I think the India story is an incredibly powerful one. I do believe the next decade will belong to India if it plays its cards right. But having said all of that, I think the market is underestimating the glitches in the India story, the flaws in the India story. And essentially, it's pricing the Indian market as if the India story will be delivered almost effortlessly.
Yeah.
So if you look at the pricing of Indian stocks and you look at the risk premium you earn over something risk free, Indian equity risk premiums don't look attractive to me relative to equity risk premiums in Europe or even the US. Now, what does that mean? If I have a choice, and I do as a global investor, and I'm looking at an Indian company competing with a non-Indian company, the fact that Indian stocks collectively have been marked up so much makes it much more difficult to find an undervalued Indian stock. I'm not saying there are no undervalued Indian stocks, but looking for that undervalued Indian stock is going to be much more difficult. You know why Indian investors will not notice it, right? Because you have pricing companies,
Yeah.
that's not going to show up, because on a pricing basis, half of all stocks will always look cheap and half will look expensive. It's a relative statement. So I think from that perspective, it's really difficult for me to reach to buy an Indian stock right now because there are so few that pass my radar as undervalued.
Right. Let's talk about the glitches and challenges that you see in the market. What are some of the biggest risks that you
It's
see?
not so much the market, it's in the India story itself, right? I mean, the
Right.
India story is built on two things. One is a billion plus people. I mean, that's something that you cannot replicate in any other country. Outside of China and India, no other country aspires or can get there, right? So you got a billion people. That means a billion potential consumers. So everything gets scaled up. There's an extra zero or two in every single number. You're a consumer product company in India. Your potential market is two times the size of Europe. I mean, that's going to show up somewhere in the numbers. So the India story is built on population, built on the fact that there's a segment of the Indian population that is as skilled as any group anywhere else in the world. But again, because it's such a big population, a 4% of that population being skilled on something is going to match up very well against any country. And it's also built on another country's stepping back from a role it used to play, which is China.
Yeah.
You know that half of all real growth globally in this century has come from China. Half of all real growth globally. So you took China out of the equation, the global economy would have struggled at about 1% growth. It's really China that delivered that extra growth. But can no longer do it for a simple reason. It's scaled up. When you're the second largest economy in the world, I don't care what the Chinese government will tell you, that economy can't grow at 10% a year. Something to remember. If you're an Indian economist forecasting the future, is if you're right about 8 to 10% growth over the next decade, that growth will slow. The math will work against you. China stepped back partly because its growth is getting more difficult, but it's also stepped back because there's more pushback against China for lots of different reasons, political, economic, trade reasons. And India is the only country, to be quite honest, that's positioned to step into the breach.
Yeah.
That's a strong argument for the India story. The weak arguments should be visible to anybody who lives and works in India. I've talked about one already, which is you got an infrastructure problem.
Yeah.
You're saying, well, how did China fix it? Well, one of the advantages of being an authoritarian regime is you can go in and broaden the streets by edict. You can say everybody, within 100 who's encroached in the street, we're going to remove from the streets and move somewhere else. You can't do that in India.
Yeah.
And I think it's a good thing, but it also means that fixing the infrastructure is not going to be easy. And it's going to be incredibly expensive because so much of India has been already built up. It's easy to build infrastructure in places where there's nothing already. It's much more difficult to do so when you've got an urban landscape that's already built up. So the first is infrastructure. The second is India's legal system that's incredibly creaky and slow. I'm not going to talk about corrupt it's just slow.
Yeah.
A slow legal system is almost as bad as having no legal system at all. So if you have, remember, business is built on property rights and enforcing property rights. By property rights, I don't just mean land and building and houses, I also mean patents. Let's say somebody encroaches on your property, your land, your house, moves into your house, you rent it out, or starts using your patent. So you sue. And the courts take 25 years to settle. You're going to be bankrupt by then. So you've got a very creaky legal system, again, not easily fixed.
Yeah.
And the third is, and again, I'm not, when you look at Indian bureaucracy, what I see primarily is not corruption. I'm not saying there isn't corruption. My bigger problem with Indian bureaucracy, like bureaucracy everywhere, is incredibly risk averse. In the old days, this used to take the form of passing files up the ranks and down the ranks. So files would get thicker and thicker, but basically nobody wanted to make a decision. And why would they? There's no upside to making good decisions because nobody says, hey, incredible, because somebody else claims credit for it. But if you make a bad decision, the finger's always pointed downwards, right? The minister in charge never says it was my mistake. It's a bureaucrat who made that decision. So what does that lead to? It leads to an incredibly slow bureaucracy,
Yeah.
getting rules changed, getting things enforced. It's something I wrote about when I wrote about the Adani Group being targeted in the short sale. I said, look, I don't think the Adani Group is essentially doing anything that most other family groups in India are not doing. They just are pushing it to their limits. They're taking those seams in the India story and taking full advantage of those seams. So I think somewhere in the next decade, those seams are going to show up either as some big crisis somewhere or as a break in economic growth. So I think when the time to fix these seams is when things look good. And right now, things look good. This is when government should move in because waiting for a crisis and then trying to act, you're reactive. So those are the seams, and I think those seams. I think, in spite of those seams, the India story will deliver. But I don't think it'll be as it'll be 4 steps forward, 2 steps back. Net 2 steps, but I think India should be ready for some slowdown, some reversals along the way because that's the nature of the process.
Completely agree with you on the legal system bit because as a business owner in India today, no one knows if you can actually take someone to court because if you do, you're in the court for 20 plus years. So there's no point even taking them to the court. I think that is a sentiment which I've heard from so many business owners and entrepreneurs. And coming to the point about what the government should fix when times are good, are there any things that you can point to which could give us a direction?
I think a few years ago, I heard talk about picking a segment like bankruptcies and trying to set up a separate legal system for bankruptcies
Yeah.
where the people owed money got paid out within their lifetime rather than have to wait for their grandchildren to get the money. I think maybe the best way to do it is to do it incrementally. Don't try to take the whole problem head on, it's too big. Take a segment where you think you can make an impact. And I think the Indian government is trying and try to change that segment 1 step at a time. I'm a great believer in incremental change. I tell my kids this because they all want to change the world overnight. I say, look, that will frustrate you and you're going to give up. Pick a small part of the world where you're likely to make change near term, make that change. It's amazing how incremental change over time can add up to real change. But I think my advice to the Indian government is don't make, the equivalent of 5-year plans. Thank God that's behind us. Don't go out of these grandiose statements about how you're going to fix the world overnight. In fact, don't make statements at all. Just do it. Because people are cynical when you see a big announcement, they say, "Hey, another big announcement. It's PR." Make small changes that make a difference in people's lives, in businesses' lives, in consumers' lives, and those changes will add up. Not just in terms of building a change, but also in building credibility.
Yeah, absolutely. And you spent a minute talking about China. I just want to go a little deeper on that front because Ray Dalio famously has said that China is the next world power which is emerging, and in India at least the narrative that we're constantly hearing is the China plus one strategy, right? Like how manufacturing is now going to shift to India. Any broad thoughts about that? Because we are seeing, at least this week, we've seen major outflows from foreign investors in India, whereas a lot of inflows are going into China. A lot of people in India also want to invest in China. How are you looking at India versus China debate?
Well, Ray is right. It's already a world power. It's not will be a world power. It is a
Yeah,
world power. It might not have the same form that Russia and US took in the last century, but China is up there almost every dimension,
absolutely.
economics, deep. So it's already a world power. I think the problem I've always had, and I'm not a macro thinker. I don't think about countries. I don't think about economy. I think about companies. And I've made a big deal and I've written a book on how when you value a company, you're telling a story. It might look like an Excel spreadsheet. So you saw my Zomato story. You might agree or disagree with my story drove my valuation. The problem I've always had in valuing Chinese companies is no matter what Chinese company you're valuing, a key character in the story is Beijing. The government is always part of the story. It could be a consumer. You're saying, why, if I value a ride-sharing company, does Beijing matter? You value Didi. Whether you like it or not, whether Didi can grow is almost a function of what somebody in Beijing decides is good. And you saw this happen in 2019 with the big Chinese tech companies, Tencent, JD, Alibaba, where the Chinese government stepped in and said, you guys have become too big, which was a strange thing from an economic perspective because these are the companies that have been the vanguards for Chinese technology becoming global technology.
Yeah.
It's almost like they were handicapping themselves. But you have to think in terms of what Beijing values. Beijing values economic growth, but there's one thing Beijing values even more than economic growth, which is control. Near an authoritarian government, control is the key driver of decision making. You know why they were worried about Tencent? Because you add up all their platforms, almost a half a trillion people were on Tencent platforms, all Chinese.
Yeah.
They were worried that the tech companies would become a threat to their power. That's something that you don't have to think about in many other countries. I'm not saying the government doesn't have an effect on US companies, but guess what? There are so many checks and balances built in that even if the government hates Amazon, it can't just say, Amazon, you've gotten too big, we're just going to cut you down. They can try. The Department of Justice is trying to break up Alphabet, but it'll fail in the courts because the courts have the final say. In Beijing, it's not the courts, it's Beijing that has the final say. And with China, that's always been my problem, even in its heyday. I think you raised the issue of foreign institutional investors. Foreign institutional investors are traders; they're not investors. They go with the momentum.
Yeah.
It's you live by momentum, you die by momentum, and that's why I think Indian companies that tailor themselves to attract foreign institutional investment are like riding on the back of the tiger. They'll be with you as long as the momentum is with you. But guess what? The minute the momentum breaks, they're out of here. I think that I'm not saying you shouldn't try to attract foreign institutional investment, a lot of money. But I think you shouldn't be tailoring yourself as a company just to make yourself more attractive to foreign institutional investors. So I'm not surprised that money flows back and forth. But I'm convinced that China is now a 3-4% growth economy. Why? Because it's, as I said, the second largest economy in the world. Now, I've written pieces about whether it's better for a business to operate in a democratic or an authoritarian regime. It's kind of a mixed blessing, right? The reason I've talked to a lot of Indian business people, and they come back from China so impressed that everything is working so well that they want something changed. The government can do it in a
Yeah.
step. So be careful what you wish for. You're right. There are so many things you can do in China at the drop of a hat that you couldn't do in India, but it's because there's no checks and balances. That same process that you enjoy now could be turned against you, and there's nothing you can do to stop it. So I wouldn't accept that trade-off of, but I think that's the reality you face. Is there'll be things that can happen in China much more quickly for a business, and that's why manufacturing went to China in the first place, right? So if you were Apple and you wanted to build a smartphone company, you built it in China rather than India because you didn't have the rules to get over. You wanted something done, it could be done overnight. You wanted a piece of land cleared, not a problem. You wanted environmental issues set to the side, not a problem. No. So I think that India has to be careful that it doesn't compete at the lowest common multiple, where it says, look, we'll break the rules for you because you're a US company, because we want manufacturing first. In
Yeah.
many ways, the India story has to happen on its own terms. And I don't think it's by being an outsourcer for manufacturing. That is not where I think the India story is to be built on. I'll tell you when I know the India story has arrived is when I look at the 20 largest market cap companies in the world, and I see 3 or 4 Indian companies that are not named Reliance.
Yeah.
Right? Maybe Reliance will get there, but for different reasons. I want to see an Indian company that's young, that came out of nowhere, that's the largest AI company in the world. Why not? Three
Yeah.
of the largest 5 tech companies in the world are led by Indians. So why can't an Indian company make it on the list? I think there's the brain power to do it. The real question is, will the system allow the kind of chaos that you need for companies like that to emerge? Much as people like to complain about the chaos that the US is built around, how things keep changing, it is exactly that disorder that gives rise to the great companies in the world. Notice the EU is very rule bound. It's always the first one to write new rules about pretty much everything. Name me one great tech company that has come out of Europe. And don't say Spotify.
Yeah.
No, I know SAP. I mean, that's an old company. So I'm not sure that that the EU model is a model that you should be even looking at. I mean, I said only half jokingly that looking to the EU for the way you write rules to build a vibrant economy is like asking a long-time vegetarian what the best place to have steak or meat in town is, right? They have no idea. So I
Yeah.
think that in a sense, India has to craft its own story. It shouldn't try to be the next China. That's not the story because I'm not sure the net effect is going to be positive. I think it's got to craft its own story on its own terms. And that requires a little patience. Don't try to do too much too quickly.
That's such a contrarian take because on ground today in India, you're only hearing about manufacturing plays and, how manufacturing as a sector is going to blossom. And, there is so much bullishness about that. But you touched upon something very interesting that I wanted to dive deeper into is the breakup of big tech. Any thoughts around that broadly? Because there is a lot of debate around YouTube being spun out of Google as a separate entity, and that's been replicated across all the Magnificent Seven companies as well. So, what are your thoughts broadly on that?
The problem with the law is that lawyers write it and they enforce it. You're saying, what's wrong with lawyers? Lawyers really don't understand business. I've insulted accountants already, might as well insult lawyers. And let's face it, antitrust law is written by lawyers. If you ask them what business Alphabet is in, they'll talk about platforms. They'll talk about the search box and YouTube, you know, and Waymo, and but Alphabet is not in the platform business. It's in the online advertising business, just like Meta is in the online. 90% of Alphabet's value still comes from online advertising. When I think about YouTube and search, and the search box, it's part of an ecosystem. All that free stuff you get from Google, you're saying what free stuff? The Google Maps, the Google Docs, my wife teaches fifth grade. She has a Google Classroom. All that free stuff is really not free. It's to keep you on the platform because if they keep you on the platform for an extended period, they can advertise more stuff in. That's why when people say they're going to break up Google, I say, based on what? Are you going to break the advertising business from the rest? But there's not much in the rest. It's almost all an advertising company. So neither Meta nor Google lends itself well to a breakup because the lines of if you think about the two most successful breakups of the 20th century in the US, one was Standard Oil in 1911. Standard Oil was the monopoly that dominated the oil business, but it was broken up geographically because the oil was in different parts of the US. They could break it up geographically. When AT&T got broken up in 1981, they broke it up into the regional belts. Each region had its own phone company and long distance. I challenge anybody who wants to break up big tech into telling me how they would break up Alphabet and Meta, or even Amazon, right? Where
Yeah.
would you draw the line? The only company that you could potentially break up is Microsoft. And you know what
That's
the business would be? That'd be the cloud business, which is now almost half of Microsoft's revenues, and the rest of Microsoft. And to what end?
yeah.
The business you're worried about Microsoft dominating is still going to be dominated because it's not like the cloud business is helping Microsoft sell more Office 365. If it is, it's too remote. So I'm not sure a breakup would solve the problem you meant to solve. So I think this notion of a breakup is coming from people who don't understand what businesses these companies are in and how they would actually the breakup would work and who would benefit. Here's the problem with antitrust law in the US. It was written to protect ultimately consumers. The reason Standard Oil was broken up is Standard Oil as a monopoly was charging consumers too much. So when it was broken up, consumers shared. And let's face it, there are a lot more consumers as voters than there are business people. So if you're somebody breaking up Standard Oil, the public is on your side. Even AT&T, you could argue people were saying they're tired of Ma Bell, of having to wait for the phone company. But if you break up the big tech companies, you know the first things that are going to go? I mean, how the heck do you think you get all this free stuff? Do you have WhatsApp, Shrishti? That's actually a
Of
silly
course,
question.
India
Because
functions on WhatsApp.
in India doesn't have WhatsApp. How much do you
Yeah,
pay for WhatsApp every month?
nothing.
Nothing. You get the you get a product you're incredibly reliant on for free. You break up Meta into WhatsApp and Facebook and Instagram. You know what's going to happen, right? You're going to have to pay for WhatsApp. WhatsApp can't be a standalone business. The
Yeah.
minute after you break up big tech, free stuff is going to be taken away all over the world. I mean, I tell people, look, you can take every other product or service that I own, but you can't take away my Amazon Prime because without it, I'm helpless. And I'm not kidding. Because brick and mortar retail in the US is broken. I can't go buy stuff anymore because stores don't exist to buy. If I need something, I have to buy it on Amazon Prime. And at $139 a year, it is the best bargain I have of all of the things I invested. I get all of my shipping for free. And I get a box every day in front of my house. I get Amazon Prime. I get to shop at Whole Foods, the grocery store, and get a 10% discount. Well, Lena Khan, who's head of the FTC, is arguing that Amazon is subsidizing Amazon Prime, and that's bad for competition. You're right, it's probably bad for competitors. But guess what? You want to make this a more even playing field. I am going to be paying for it as a consumer, not Amazon. So, big tech, the breakup, it sounds populist because everybody hates big tech in the abstract while they live in big tech's platforms. Breaking it up is not going to be easy to do, and it's not going to be public from the popularity standpoint. Not if you want to win in the next election, take away Amazon Prime from people, see how that works out for you.
Yeah, absolutely. And there's so much debate in India as well, right? Because these tech companies seem to be gaining so much market share and they're taking away from Kirana stores and all the offline mom and pop stores. And people are demanding regulations and there's so much talk around that.
All
But
these, I'd be curious, all these people who are talking, I'd like to know how much time they spend every day in one or more of these companies' platforms. I mean, why do we talk about they? It's we, right? I
yeah,
mean, during COVID, when what was then the FANGAM stocks, Facebook, Amazon, Netflix, I
yeah,
actually ran a little exercise. Starting with the time I woke up, I kept track of what platform I was on every moment of the day. I woke up to my Apple alarm going off. I was already in the Apple platform. The first thing I did when I woke up is I asked Alexa what the weather was going to be that day. I'm on the Amazon platform. And all through the day, I kept track. And here's the scary thought. During the course of the day, for all but 21 minutes, when I forgot my iPhone and took my dog out for a walk, I was in at least one of the company's platforms and often on two or three of the platforms. This is not a they versus you, it's a we.
yeah,
We, for better or worse, are attached to these platforms. So when we talk about they are doing this, they are doing that, the question we're asking is why are we doing it? Because we find it convenient. I'm not saying it's a good thing or a bad thing, but the Pandora's box is open. We're
yeah,
all in these platforms, and the more we get to them, the more power we give these companies. And then we complain about, I mean, I've always been amazed at people who complain about the privacy issues with
yeah,
Facebook, and often they'll be complaining on Facebook about how Facebook is invading their privacy. And while they're complaining about Facebook, they will be spilling the beans about what their parents are doing, what their children are doing, what car they bought. And you say, hey, you don't want the world to know what you're doing. Stop sharing about it
yeah.
all the time. We get the companies we deserve. And guess what? We use tech all the time and we're getting the tech companies that reflect it. And that's my question. Why are these companies all concentrated in the US? I mean, China had its own, but the Chinese companies took off because China explicitly or implicitly restricted the US companies from coming in. Baidu is the largest search engine in China, not because it's a better search engine than Google, but because Google was explicitly forbidden from having its search box out there. You look at the great tech companies of the world, those
Yeah.
tech platforms we're all complaining about. They have, and rather than complain about them and act as if this is some imperialist invasion of India when Amazon opens up, why isn't there an Indian tech company able to do this thing? I mean, I would wager that if you took these big tech companies and look at who's building these platforms, who's heading these companies, I mean, it's Indians. So why are they doing it in India rather than in the US? So that's something to ask. It's about process and structure, which will allow small companies to explore out of the box. I'm glad to see the IPOs that I see in India.
Yeah.
But I'd like to see some of these IPOs rise up the ranks, and maybe it'll happen in the
Yeah.
next decade to be among the 10 largest companies in India to begin with, and potentially among the largest companies in the world. You want the
Yeah.
rest of the world complaining about Indian tech invading. That'll tell you you were right. Is when a Brazilian president says Indian tech companies are taking over Brazil. Hey, that's a good thing. You've arrived now, right? Because
Yeah.
that's exactly what you should be aspiring to be.
I think that's the dream. But the India market is still in a very nascent stage when it comes to understanding how to value these new age tech stocks. What is the
No, no, no,
framework?
no, 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 don't play that game with me about poor Indian investors don't understand this. Every market is a pricing market. Let's be quite honest. You think people bought DoorDash because they did the assessment of market size and market share? They bought DoorDash because everybody else was buying it. Markets around the world are far more similar than dissimilar. This notion, I mean, I've always in India found this notion of retail investors versus professional almost laughable because implicit there is professional investors are smart. They live in Mumbai. They read all the finance, and retail investors are these unwashed masses. They're cab drivers buying stocks because they heard about it. Guess what? Those professional investors are just like retail investors. They buy on mood and momentum. They just dress it up after the fact with analysis to make it look like it had deep thinking behind it. We're all the same. You scratch the surface. We're all traders. What do traders do? They buy at a low price, they sell at a high price. What causes the price to go up? Who cares? As long as you got the direction right. We need to stop this dance about if we make investors more sophisticated, they will stop being greedy and short term. We're human beings. Greed
Yeah.
and short term comes more naturally to us. It's not going to go away. My concern with the Indian market is it's been too good for too long, where everything you touch turns to gold. And when that happens, people get sloppy. I'm constantly amazed the number of YouTube channels that I get redirected to from people and say, "What do you think about this YouTube channel? This person says you can make money by buying options." I mean, outlandish schemes that border on not just gambling, completely ignorant gambling. But I think that people are easy prey because they misunderstand the reason you invest. You don't invest to get rich. You invest to preserve and grow wealth. It's a first lesson I think we need to imbibe, but it's such a difficult lesson because everybody wants to get rich quickly. And when you do that, you're going to overreach. You're going to gamble. You're not going to invest. And unfortunately, the Indian market as a gambling market has rewarded those gamblers. You get reinforcement for doing the wrong thing, so you do more of it. Eventually, it catches up with you, just like it does in a casino. So I think it's not that Indian investors are sloppier or less sophisticated than investors elsewhere. It's because they've been rewarded for doing the wrong thing for so long that they tend to get even more sloppy about what they do. It's the nature of any market that's been a bull market for a while. And India's had a long run.
Yeah. But coming back to the question, what is the framework you would encourage people to think about when evaluating these new tech stocks?
Just think like any other. I mean, first, don't call them new tech, old tech. It's food delivery. Let's be quite honest. Many of the new tech companies are tech only in the smallest sense of the word. They should all be paying GL, a third
Yeah.
of their earnings. You know why? Because without the smartphone in people's hands, there is no new tech about this new tech business. They're just taking the smartphone and taking an old business and delivering it because of the smartphone. So much of what you see as tech disruption or innovation in this space has been this very, very incremental innovation. You come up with a new way to raise crops with technology and you double crop, that's innovation. You come up with a new way for me to order food. Come on, let's not use the word innovation. You took my smartphone, you put a couple of great software engineers in there, you wrote some software code to allow me to connect with a restaurant. This is what innovation has come down to. So when you think about these new tech companies, first question I ask is don't let the new tech fool you. Ask what business are they in? Because that's where you got to go, right? To understand the business. No, so that's why when you look at Zomato, I think the story is much bigger. They now can deliver all kinds of stuff, but here's where understanding what they do comes in. You're expanding from the restaurant delivery business to grocery delivery. That's great, right? Or electronics delivery. Here's the underlying business economics you got to keep in. In the restaurant delivery business, they keep about what 20 to 22% of every payment.
Yeah.
Why can they afford to do it? Because in a restaurant, the cost of food, even at cheap restaurants, is about 40% of the actual meal. It's the other costs that make the 60%. So a restaurant can afford to give away 20% and still make money because the food doesn't cost 90%. You know what the gross margins are for a grocery business? They're like 6%.
Single digit. Yeah.
Single digits. They can't pay 20%, they'd go bankrupt. So if you grow the grocery delivery business, I don't care how much promise you offer me in terms of revenues, I've got to scale your margins down to reflect the fact that that grocery business might pay 2 to 3%. Extend to the electronics business. Let's say you can order a new TV and that Zomato is going to pick up the TV from the electronics store and deliver it. There is zero chance the electronics store is going to say, hey, you can keep 20% of the price of the TV for delivering it.
Yeah.
It's not going to happen. So when you get disconnects, it's because people see the good part of a story. Zomato is going to grow a lot faster because they don't factor in that the places it's growing come with different business. And that's why going back to core businesses, asking questions about businesses is a healthy part of investing. I'd encourage people to do it and not hide behind, I'm not a this has nothing to do with financial analysis. I'll wager that anybody who's talked to a grocery store owner knows that they're not taking the lentils and doubling the price. The margins are not 50%. It doesn't work that way. It's common sense.
Yeah. And when you think about, innovation in business model, I think one of the reasons you're also hinting why Indian companies haven't broken through is because a lack of innovation fundamentally, right?
Shallow innovation, right? A lot of innovation has been the easy innovation. It's not just them, right? If you look at the innovations over the last 15 years, in much of the world, it's been surface level innovation. And much of it is built on the smartphone. The day that you look at some of the biggest companies, they've been built off that day when Steve Jobs held up the very first iPhone, and people looked and say, "I'd like to have one of those." So much of the innovation in the last 15 years, not just here, but also in things like energy. Much of green energy. I mean, solar energy, the solar panels are not the great innovation. It's finding a way to store the energy that you get from your solar panels that would make a difference. There's a difference between shallow tech and deep tech. And a lot of the innovation in the last 15 years has been shallow tech innovation. I'm not saying it's bad innovation. I'm not taking issue with these companies, but to argue that these companies are fundamentally changing the economics of a business is really not true. So I think that we need to, what they're creating, and we have to be well aware of this, and this is a play out, is they are making businesses that used to be splintered into winner-take-all businesses. If you want, we'll talk about that next because it has implications. But I think in terms of making real change, there's a big difference between innovation that changes the way I order food from innovation that changes the way food is made.
Yeah. I think the argument there is because, I have spent time in Silicon Valley and everyone there talks about, all the basic problems are already solved because it's a developed country. So you can go after the big moonshot ideas, versus in India, you're still fixing the broken stuff, right? Like even the
Yeah.
basics are not covered.
No, but if you define basics as just food, maybe, but even the basics, how
Last
much in
mile
the US?
broadly.
No, but those are not the basics, right? Basics are food and housing, and the US has a huge housing problem.
Yeah.
You know what innovation you'd rightly like to see? An innovation that can put up housing cheaply and quickly. It's not innovation that you can put on a smartphone.
Yeah.
There is no country in the world that can claim that its basic needs are met. The reason Silicon Valley focused on shallow tech was it's easy to build up, it's easy to scale up, it's easy to price and exit. Let's be quite honest, Silicon Valley plays the pricing game just like investors do. It's not
Yeah.
interested in building great businesses, it's interested in making great trades. I mean, I've had an issue with how Silicon Valley has built companies in the last decade, where scaling up was valued far more than building businesses. And I think we're going to pay a price for that over the next decade because these companies scaled up to become a $100 billion company. How the heck does a bad idea like leasing properties for 40 years and subleasing it for 3 months take off and become a $100 billion business? That's what happened at WeWork
Yeah.
because you had people supplying it capital because they wanted to exit at the higher price.
But wouldn't one argue that the whole venture capital industry is exactly that?
But they're not bad people. They're in the business of pricing and exiting. So it's not their fault. As long as the market is receptive to it, they're going to do exactly what they're going to do. It's Pavlovian, which is reinforcements feed behavior. And that
Yeah.
behavior was fed by the fact that you could scale up, exit. And the more I rewarded you for doing what they did with Uber, the more you're going to continue to do it. It's not, and that's why I talked about process and structure, is you got to think about what VCs can do in the economy. And you can ask, what can they not do? And think about how do you create a structure or a process where the things that are difficult to do get done. And that's why I said infrastructure is a much more difficult problem than food delivery. You're going to be able to order food from a restaurant, get it in 15 minutes. Congratulations. But you can't drive to that restaurant because there is no road there. That's the problem that you want innovation to fix. And that's a tough problem to fix.
Also, let's talk about the winner takes all model, right? In a market like India, everyone thinks that, there is space for multiple winners to emerge in the same sector. What is your thought?
No, it's the economics of the business, right? There are two things that create winner take all business. One is networking benefits. Reason that you're never going to have more than two or three big delivery companies at the end of the process is if you're a restaurant, let's take restaurant delivery, you want to be where everybody else is, which means that in restaurant delivery, ultimately there are going to be two, three. In every market you look, there's some markets with only one. Ride sharing is the same thing. There will never be 20 ride sharing companies because again, networking benefits kick in. The
Yeah.
second is economies of scale. If economies of scale are huge, the larger you get, the more cost advantages you have. There again, you're not going to get a splintering. What this effectively means, there are some businesses which will tend towards consolidation because the economics of the business drive you towards consolidation. Governments can try to push back, right? That's what the Department of Justice tried to do in the US when it broke up the phone company. They said, no, we want, you know what's happened to the telecom business in the 40 years since AT&T was broken up? It's reconsolidated into three companies. It's almost like you can't fight the laws of physics. You can't fight the laws of economics. If your core business is a business that lends towards consolidation, doesn't matter how big the market is, you'll still get consolidation. You can't force competition into a market that is consolidation at its core, right? So I think it's got nothing to do with the size of the market. Now, right now in India, much of the market is splintered because it's the way it was set up. It's localized, it's regional. You can
Yeah.
say somebody from Mumbai is never going to be able to understand, Chennai enough to be able to grow there. And that might have worked, but one of the downsides and upsides of technology is that you might be able to build platforms that essentially cut across. Flipkart can retail across the country in a way that the old retailers could not, because they had to be localized and they had to be geographical. So I think one of the things that's happening, because again, I'm blaming the smartphone, and what's created is creating businesses which used to be splintered have become consolidated businesses. Advertising, car service. I can go through the list, but
Yeah.
here's the consequence. If in each business there are only two or three winners, guess what you're going to see in the market? You're going to see that much of the market's winning comes from the winners at the top. That's always been true, but the difference in the 21st century is the winners keep repeating. I mean, I like to give the statistic. You take the Mag 7, which has replaced the FANG-AM. The Mag 7, as of October of 2024, had a total market cap of $12.2 trillion. Repeat that again, 12 point. That's larger than the second largest equity market in the world. That's larger than the market cap of all of China. Seven
Yeah.
companies. And over the last 15 years, they've accounted for 22% of the increase in market cap of all US stocks. Seven stocks. There are 6,500 US stocks, seven stocks have accounted for it. And every year you have people ringing hands and, so, how come the big winners keep. This is a feature, not a bug, of the economics that we've built up with technology. And it's something I think we're going to be grappling with for the rest of the 21st century. It doesn't mean the same seven stocks are going to repeat, but you're going to see this pattern of 10 or 15 or 20 companies accounting for the bulk of the increase in market value in pretty much every market.
Yeah, on the same thread, there's the term called consistent compounders, which often applies to companies like
Only in,
Infosys, HDFC.
only in hindsight.
Yeah.
Only in hindsight, right? I would love to know somebody who bought Infosys, or find that person who bought Infosys in the 1990s saying, because it was a consistent compounder. They might have bought Infosys for a different reason, high growth company, tech company. In hindsight, it's a consistent compounder.
Yeah.
So those are all hindsight biases. That's why I have very little time for books about 10 baggers and 100 baggers. Nice stories,
Yeah.
but it violates the basic laws of statistics, right? There's a selection bias. You pick the biggest winners and you work backwards. You come up with a storyline. You know what you're implying is if you can find other companies with the same storyline, they're going to be just like this company. History doesn't repeat here.
Yeah.
Right? So I think consistent compounders are a hindsight. As an investor, those are the kinds of companies you want to invest in, companies that grow. And does it have to be consistent? Not necessarily, right? Do you really care that you made a 25% compounded return with an inconsistent path there? You just want winners over time.
Yeah.
I mean, that's the essence of investing. So unfortunately, you're not going to find those lessons by looking deeper and deeper at the past. Yeah. Which is one reason I wouldn't spend too much time assessing historical winners, because the biggest driver of who wins and loses over time, and I hate to be the bearer of this news, is luck, being in the right place at the right time. And you're never going to replicate it.
Yeah, but any thoughts around, like for example, you identified Mag 7 when they were fairly undervalued. Now you compare them to middle-aged companies like the consistent compounders I was just talking about, Infosys, Asian Paints, etc. So obviously the returns that you can generate from both the classes of companies is very different, right? So how should investors think about finding these kind of undervalued opportunities despite the stage the company might be at? Or is that even possible? Or is it only possible in younger companies?
I'll give you the key words: at the right price. At the right price. I mean, remember, none of the companies you named are essentially companies that you can classify as winners if you bought them at the wrong price. At the right price,
Yeah.
any company is a great investment. We need to first separate companies from investments. A great company can be a terrible investment. A terrible company can be a great investment, because going forward, it's the right price. I would say people get too focused on the company side. They read about how great the company is, how amazing the company is, but they never ask the question, am I getting it at the right price? I mean, I have a matrix I put up in my class, where in one side of the matrix, I put what I think about a company. It can range from best company ever, amazing, all the way down to worst company ever, abysmal. So that's one side of the matrix. On the other side of the matrix, I put what the market thinks about the company. By the market, I mean the consensus, the investors' base, ranging from abysmal company to best company ever. Then I say, look at where your company falls in this matrix. If you have an amazing company that the market thinks is the best company ever, you got a problem, because the price reflects the best company ever, and you just valued it as an amazing company. Nvidia is an amazing company. The market is pricing it as the best company ever. It's a bad investment. Conversely, if you have a bad company that the market thinks is abysmal, hey, guess what? You got a bargain. I don't think people think enough about the price they're paying. They spend far too much time on how great the company is, how amazing the company is, what it's doing. And I think we need to think about the price a lot more as investors. That's a burden you bear as an investor, because you can find a great company, but at the wrong price, it's a terrible investment.
Yeah, absolutely. You recently also discussed the dynamics of corporate venture capital, CVC as you call them, and the potential returns they offer. In India, we're seeing corporates like InfoEdge making direct investments that have yielded remarkable results, as seen with Zomato and Policy Bazaar. What should one think about when deciding whether to invest in startups via VC funds versus direct investing via CVC?
Well, I think first, corporate venture capital, for the most part, is with mature companies that have cash coming in, don't have enough investments. I mean, that is the typical corporate venture capital start, right? So Google started this when their existing businesses had started to slow down. So it's either used as a replacement for organic investments because they don't have them, or to kind of create side benefits for the company. So they're investing in many big tech companies, invest in small tech companies because they think they can, or as options, which is there. You're in a business like AI, you don't know who the winner is going to be, and you don't want to invest too much in one. What do? You take positions in 10 different AI technologies, hoping that one of them pays off. Microsoft, OpenAI, best corporate VC investment ever, right?
Yeah.
So first, you got to recognize that corporate venture capital can come with a very different set of motives than a typical venture capital. Typical venture capital is you want to get into a company as a startup, you want to pick the right company and exit at a much higher price, either by selling to another company or going public. So corporate venture capital has a bunch of motives, and it has a parent company that feeds it money, as opposed to traditional venture capitalists who has investors who invest and come and ask them, what have you done for me lately? So I called it the sugar daddy effect. I mean, I know it sounds sexist, but basically, if there's a parent company that keeps supplying you capital as a corporate venture capitalist, you don't think like a traditional venture capitalist. You don't have that desperation of, I have to make returns first.
Yeah.
So you can argue that it's a strength. It makes you more long-term, and corporate venture capitalists tend to exit much less frequently. Corporate venture capital-backed firms fail less frequently. But they also get fed capital far too long if they're failures. In other words, we don't cut off. We're not ruthless enough. Collectively, corporate venture capital underperforms traditional venture capital, collectively. Okay? But the very best corporate venture capitalists would match up with the very best venture capitalists. Alphabet's venture capital arm is a very good, Google Ventures is a very good venture capital arm. So when I looked at these groups, and it was just corporate venture capital, I looked at sovereign wealth funds. I looked at green investing. Collectively, each of these groups punches well below its weight. With sovereign wealth funds, collectively they control 12 trillion, but the way they invest doesn't carry that weight. The question was, why does that happen? And the answer, I think, is not enough failure. Terrible thing to say, because we view failure as a bad thing. But in capitalist economies, what makes markets work is failure, that the worst among the group are allowed to fail. And while we mourn those failures, it's what allows the rest of the business to succeed. We don't allow failures often enough in this space. So with corporate venture capital, my advice to a company is be more willing to let your ventures fail, and don't let the fact that if the funding and the ego get in the way of letting them fail. Because if you don't let your bad ventures fail, collectively corporate venture capital is not going to deliver the kind of returns that you expected it to.
Yeah, and a lot of global attention is now on India, and domestically also the monthly inflows into equities are at an all-time high of $4 billion per month. If you were tasked with building an India portfolio, I know you said you don't invest in India, but if you were to look at companies or sectors, what would be the most promising over the next 5 years, according to you?
I think healthcare. No, I mean, let's face it, of all the things that, and I've said this before, of all the things that Indians are going to aspire to reach for first when they have disposable income, it'll be healthcare. It's a country that about 40 years ago, a large segment of the population, it wasn't just that didn't go, they never went to a doctor. They basically would go to a hospital if they were deathly sick, partly because they didn't have the income to do it. I think as Indians get more prosperous, get wealthier, you'll get more people in the middle class, the demand for healthcare will increase. And that is going to show up in every dimension of healthcare. And I think that if I were this, and this would be the kind of technology that is deep, a real change. This is not a better app to deliver, food to you or your new TV to you. This is about you being able to not just find healthcare when you know it need it, but collecting the data that you know there's an epidemic in a part of India that's taking off that you want to deal with. So from both a perspective of controlling problems before they become pandemics and from the perspective of people seeking out healthcare, that would be the sector that I would be most interested in. And unfortunately, the big name healthcare companies in India tend to still be outward looking, right? You're investing in generic drug companies or pharma companies.
Or
But I want to
hospitals?
get it, or hospital. But I want to get, that's the space where I'm looking for somebody who's coming up with interesting new ways of attacking the growth in healthcare that's going to come and being part of that market. So if I were looking at startups, those are the startups I'd focus on. Unfortunately, they won't have the kind of growth profile that a Zomato or a Swiggy might have when they're going public because it's much more hard, much more work to build up these businesses. And I was writing about Nike. I read this book called Shoe Dog,
Yeah,
which is Phil
love
Knight's
it.
autobiography. It's a great book. But as you read the book, you read about, I mean, he started in about 1965. I mean, the work that he had to do to build up the company took decades. And then you look at the companies that have grown the 21st century, you never heard of the company. When was Zomato founded? Some guy in Bangalore gets up in 2000, and 10 years later, it's this scaled up company. It's become incredibly easy to scale up businesses, but that comes with a consequence. You don't get the kind of growing pains and learning that comes from a company growing gradually over time. So I think that's one of the things that 21st century companies are going to find, that they grow up too fast. In the process, they built into their business model flaws that might be fatal. I mean, I don't know whether ride sharing can be saved as a business because it's scaled up so much so quickly. I can't think of a single healthy ride sharing company in the world. And I say that as somebody who's an investor in Uber because I got it at the right price. It's a business with no stickiness on every single dimension, customers, drivers, system. So I think it's very difficult to build a sustainable business model with no stickiness.
It's very interesting that you say that because, in my at least current understanding, I don't see too much funding flowing towards healthcare. And I think it should change with the advent of AI. At least that's the hope. But this funding is not there for the sector.
AI is
People,
not going to create the funding, right? Unless you put the AI just as a buzzword.
yeah,
Healthcare is a work in progress. It is going to take real infrastructure building on
yeah,
the ground. It is going to take decades to scale up. And unfortunately, this is the bad thing that came out of the last decade is people get used to, hey, can you quadruple your revenues? Can you get to 10 million in 2 years?
yeah.
And the answer is not with a healthy business model. So I think, it's going to require a different kind of venture capitalist. And I hope that a subset of VCs are there who will say, look, I'm not interested in companies that scale up in 5 years that I exit in, but I'm interested in businesses that are much more long term.
That'll probably come from family offices and not funds because of the limited
Right.
fund
And
cycle
I
that they
think
have.
that if you're a family office, that's something where, you make a difference both economically and socially, because this is something that's going to save people's lives, not
Yeah.
get biryani to them 20% cheaper
Yeah.
as a celebration, right?
Yeah. And you've highlighted how some industries may face existential threats from AI and automation. Which sectors or company types do you think are most vulnerable, and how do investors account for these disruptions?
I mean, AI is just a fancy word for two trend lines that have been happening for decades. The first is that computers are getting more powerful and cheaper, right? I mean, I think about a smartphone today. That smartphone is 20 times more powerful than the Mac 128K that I used 40 years ago as my computer. So computing is getting cheaper and more powerful. The second is data is getting more extensive and stored. Data, not just quantitative, but qualitative data. As we said, the tech companies are collecting it. That's part of the cloud business. So you got more powerful computers, far more data. AI is just the coming together of those two, and we call it AI, but it's been around for, again, 3 decades. I mean, you might know, if you're old enough to remember, IBM came up with a version called Watson, which could play chess against the grandmasters in the 1990s. And it turned out that IBM's computing chess master was better than the very best grandmaster in the world. So,
Yeah.
and the reason it got better is chess is a very mechanical, it's intellectual, but at the same time, every move you see has been made before. So if I feed a computer every chess game ever played in history, whatever you do, it's seen before, and it knows what to do to beat it. So that could kind of give you an insight in where AI is going to make its quickest entry. It's going to be businesses which are mechanical and rule based. Remember 30 years ago when people were told to learn to code? These were people, especially in the Western economies, who were factory workers, where they were losing their factory jobs. And I thought it was incredibly elitist, where people would say, just learn to code. You're telling a 55-year-old man who's probably has a high school education, learn to code. You know how insulting it sounds? In a weird version of karma, it might be the coders who are learning, who will hear those words this decade. Because what's coding? It's mechanical, it's rule based, it's perfectly designed for AI.
Yeah.
So coders are going to learn to be imaginative and say, what does that even mean? I think the worm is turned, and in a sense, AI is going to have its biggest inroads in businesses that are mechanical and rule based. Now, if I were a conspiracy theorist, I would say that that the technology companies have spent the last 20 years making it easier for AI to replace us, because with the technologies we have, we're all more mechanical and rule based than we
Yeah.
used to be. Yeah. And I think, in a sense, we're setting ourselves up to be disrupted. And I wrote a piece on this about a bot that's been created. There are multiple bots that have been created to replace me. And I talked about what the bot can do better than I can. Now, first, it can remember every blog post I've ever written. I've written 2,500 pages on my blog. I don't remember many of them, but a computer can. The data updates that I do at the start of every year, completely mechanical. And I screw up all the time because I let my mind wander, I get bored. The computer doesn't. I said, there are things that I do that are bored, and I think, ego to say that can never happen to me. There is a big chunk of what you do. So I reframed the question. I said, there are lots that I do that a bot can do as well or better than I. But what can I do that a bot cannot? And I'd like you to think about these things. The first, I think, is that a bot, by its very nature, is going to be mechanical and rule based. It's not going to be able to, I talked about stories and numbers, about using both sides of your brain.
Yeah.
The second, I think, is as human beings, one of the things that I think makes us interesting is we can do lots of. At least we used to be able to be. I mean, we didn't have to be pigeonholed. I mean, I talked about the Renaissance man, and I talked about in the context of the Brunelleschi Dome in Florence, one of the most amazing freestanding domes, the largest freestanding domes in the world. And the guy who built it was not an engineer, he wasn't a scientist, he wasn't a construction person, he was an artist who taught himself enough of the other disciplines. I see we need more Renaissance people. It's not easy to do. And the third thing, and I think this is something that is worth thinking about, is, one of the things we do as human beings is we make these disconnected things connect in our mind. I use the example of Newton sitting under an apple tree. The legend is an apple fell on his head. And rather than cursing the apple or eating the apple, he said, why did the apple fall rather than go up, and came up with the laws of gravity? Or Archimedes jumping out of his bathtub and running through the streets naked saying, Eureka, Eureka, because he discovered that the water he displays was not based on his weight, but, so in a sense, the great discoveries that came out of accidental connects. And I call these aha moments as human beings. And they happen when your mind is idle. Remember, you're warned about having an idle mind. Well, one of the upsides of your mind having nothing to do is these disconnected thoughts connect. And we used to have a lot of idle mind moments 30 years ago because we had no choice. You were standing in a line in India or the US waiting for something 30 years ago. You had nothing to do, right? You had to talk to the person next to you or just think. Today, we're so busy on our smartphones or devices, we filled in those idle moments. The things we're doing as human beings is, I think, making us less human. And by making ourselves less human, we're setting ourselves up to be disrupted. So I think that as businesses, if what you're doing is mechanical and rule-based, be careful. No, a bot can do that for you. If what you're doing requires imagination, requires these aha moments, you're in much better shape.
How do humans get disrupted? What does the future look like?
I would hate to see it, because if humans get disrupted, you'll be sitting at home without. I mean, the first layer is you're going to be like that factory worker 30 years ago. What happened to him or her? Mostly him. He lost his job. He lost his income. He lost his health care if you were in the US. The rest of your life was scrabbling to just survive. That's going to be the first layer, is the people that AI displaces are not going to be the people who come up, who are the investors, who are the people. They will be the people at the bottom of the trenches. But guess what? AI rises up the ranks. If what you're doing as a CFO is mechanical and rule-based, why do I need a CFO? Why can't a bot be a CFO? So I think that the problem for AI is it's not going to just be at the bottom rungs. It's going to come after all of us. And that's a world where I don't know what the end result is going to be. Maybe the people who make the bots will become the trillionaires of the future. And maybe the rest of us will all be little cogs in the wheel saying, what do we do to make it? But remember, it's not just the income you lose. Much of our value as human beings is tied to what we do in our jobs, in our professions. If a bot does it, what exactly are you left with? You look at the rates of depression among people that over the last 15 years, as we made their lives easier with technology. The rates of depression have increased, especially among young people. I don't think we've thought through this well, but unfortunately, the genie's out of the bottle. That 15 years from now, we'll look back and say, I wish we hadn't done that. That's a very real possibility. But I don't see how you stop this train. It's on the tracks already.
Yeah. Or we get shipped off to Mars.
Or we get shipped off to Mars, but what do we do on Mars for who, and who would we work for, right?
Yeah. Professor, many young and first time investors have only experienced high returns and low interest rate environments, leading to very bullish expectations. What advice would you give to someone in their 20s or 30s about setting up a sustainable and resilient portfolio?
You know what? Whatever advice I give you will have no effect. You know what will teach them? Pain. And all I will tell them is, you felt no pain, you will in the future. And when it does happen, don't give up on equities altogether, because that'll be one response. Think of it as a learning moment, change the way you do things. But I think that the only way you learn about risk is when you get that feeling in the pit of your stomach as you see your portfolio melt down, and there's nothing you can do about it. Until then, it's just an abstraction. So I don't give, that's why I don't view my writings as giving advice to people. I talk about my experience, I talk about my actions, because it's not my business to tell you your experiences and your actions. So I think learning has to come from within, not from without. You can read every book on risk you want, but it's not going to make you sensible about the way you take on risk. But the thing about risk is, reality has a nasty way of rearing its ugly head and reminding you this is what risk is, and you will get that reminder.
And speaking of your life experiences, when you experienced enough, because you've experienced enough market cycles, what is your reaction when you go through a portfolio meltdown?
The first thing is, investing to me has never been in my top 5 things about in my life. I mean, I'm much more worried about my kids, my life, my friends, and I think that's in a sense healthier. Now, with investing, I call this the sleep test, which is, if you're lying awake at night wondering how your portfolio is doing, you failed the sleep test. I've never spent a night thinking about what my portfolio has done, and but then I have to act on that basis. I don't do things that make me fail the sleep test. I don't concentrate my portfolio. I don't buy 3 stocks or 5 stocks, because no matter how, I hate the word conviction, but conviction is a big word. No matter how much conviction I have in my investments, I don't have enough conviction to put them in 5 stocks and not lose sleep. I don't make outlandish bets. My rule in investing is never invest money that if you lose will change the way you live. Because that's going to create, again, this loss of sleep. So don't make investing the center of your universe. If all day long all you can think about is what you bought in your portfolio, what you've sold, you've lost your way. That's not what life is about. In fact, even in economics, the end game for every person is not maximizing wealth, but maximizing utility, which is just a fancy word of, hey, what is it that gives you happiness? And in your lifetime, is a collection of things you're doing delivering more happiness or less? And the answer is less. I don't care how wealthy you've become or how much your portfolio has gone up. You've lost the game of life. So I've been lucky enough that I've never had to think about my portfolio as a center of my. Have I had bad years? Of course, like everybody else. Have I made bad investments? Sure. Have I lost sleep about them? Never. I mean, regret is something that I never spent a day thinking, I wish I'd bought that stock at 40 or I'd sold that stock at 60. Because what is it going to do for me? So you'd be surprised how little time I think each day thinking about. I mean, people seem to think that I spend all day thinking about stocks and investments. They say, "What do you think about Zomato?" I said, "I haven't thought about it for a year and a half. Now I'll think about it now." I get repeated questions. What do you think about the Adani Group? I stopped thinking about them 2 years ago. After I started, why would I think about the Adani Group on a daily basis or a weekly or even a monthly basis? What difference is it making to me? So I think we need to know when to let go of those investments and think about the things that truly matter. And I get reminders of that every day.
What you're saying is so deep and powerful. I hope people take this as a life lesson, and not just an investing masterclass, which it has been so far. But this is so strong and powerful. Was there a life shift that happened along the way? 40 years of doing this, did your viewpoint on the world change?
It
at
was a
some point?
day, first day, during my second year of my MBA program. I was a TA for a class because I needed the money. That's purely the only reason I did. I actually had a job lined up at an investment bank where I've caught the wave of investment banking taking off, 1981. And I was 20 minutes into the first session of the class. It was an accounting class. I don't even like accounting. When I had this, I call it a moment of grace. And we all have moments of grace where I said, this is what I want to do with the rest of my life. I want to be a teacher. Yeah. And I'm glad I had that moment because who knows what the reason I am where I am and I do what I do and I am, it's part of what me is I'm a teacher. I'm not an academic. I'm not a researcher. I'm not a professor. I'm not an expert. No, I'm not a valuation specialist. I'm a teacher. Everything I do in my life has been an extension of teaching. And teaching gives me joy. I tell people, it's not a joke. I've never worked a day in my life because I don't consult. I don't do expert witness work. I've taught. And for me, teaching has never been work. It's been fun. It's been sharing. It's been, because teaching is one of those things where by sharing, you actually get wealthier. It's not giving away stuff. It's adding to your wealth. So to me, that choice I made 43 years ago has shaped everything I do. And I think about what would have happened if I hadn't been open to that moment. Because let's face it, we all get these, I call these moments of grace where there's something you should be listening to. And I'm not saying this as a deeply religious person, but as a spiritual person, there is that, and we're too busy. And in fact, it's getting worse, right? We're looking at our phone. You're not going to get that moment of grace because you're looking at some Facebook post that somebody put up. Those are not moments of grace. Those are moments that pull you down. So I think we need to allow for those moments of grace, be open to them. And I hope that your listeners all get their moments of grace and find that thing they were meant to do. No, I got lucky.
That would be amazing. I was going to ask you about your asset allocation and portfolio construction strategy, but let me ask you about your life construction strategy because that I think you've done very intentionally and thoughtfully. So would love to talk about all things life rather than your portfolio.
I love construction. I mean, they take it a day at a time. I mean, I've never been one to plan 10 years out and say, this is what I want to be. In fact, one of the things I deal with every week is high schoolers who write to me from all over the world saying, I'm 10th grade, I'm in 11th grade. I'm thinking about, going to this university and getting an MBA and going to work for an investment bank 20. I mean, and my response is, you're 15 years old. You got an entire life in front of you. Enjoy your 15-year-old life. But we're so busy and I don't blame them, right? Because they're taught this. You got to be long term, you got to be a planner, you got to write that letter to the university telling them how you've thought through your life path. And I'm glad I never got those lessons because I've always lived, my life a day at a time. Doesn't mean I haven't screwed up that day, but it's just a day, you know. And it's amazing how incrementally over time those choices you make on a daily basis add up. I try to get this message across to my kids sometimes when they're willing to listen, saying, make it a day at a time, enjoy the day, and it will add up over time.
And in today's world, being a parent, you feel so many feelings, right? You're constantly feeling lost about how to direct your kids, what direction and guidance you should give them, what's too much, what's too little. I think parenting has also evolved so much. As someone who's raised 4 kids, what would your parenting tips be?
Light touch, a light touch. No. I mean, I look at my 4 kids, and you know what? They were baked in the oven the way they are. Much as we like to think we shape our kids, they
Yeah.
come out of the womb as very different human beings. It amazes me. They all grew up in the same household at how different they are as human beings. And I think that a light touch means you let them, I mean, they still need guidance. They need guidance to not do, I mean, the only guidance I offer is don't do things that are not reversible. Don't get a tattoo on your forehead, because you might like it right now, but 10 years from now, if you have to interview for a job, that tattoo might be a big problem. So don't create irreversible harm. But guess what? You got to let them make their mistakes, make their choices. I know as Indian parents, there is this urge to overplan for
Yeah.
your kids, to think for them, to say, this is a better university for you than this one. This is a better choice. And I understand where that impulse is coming from. It's coming from a good place. You want the best for your kids. But I do think that a light touch will have a much bigger influence than a strong one. I mean, I get Indian parents sometimes call me and ask me to talk to their kids about, why they should go to business schools. And I said, well, why would I do that? Because maybe they shouldn't go to business school. And in fact, when they let me talk to their kids, it's actually a little subversive. I say, what do you really like to do? I mean, you like art? Maybe you should think about something that you build around art. Doesn't mean you take a completely impractical path.
Yeah.
But I think we got to take our kids as human beings with their own makeup and think about what can we do that can allow that makeup to kind of prosper out there, become. But I think a light touch is much better than the heavy touch that you sometimes see parents impose.
Love it. And my next question is around the regret minimization framework that Jeff Bezos talks about a lot, where he thinks of himself at the age of 80 and takes a lot of life decisions backwards. What do you think your three pivotal life decisions would have been, in terms of one significant learning, one regret, and one pivotal life decision? Let's talk about those.
Learning decision is just a collection of learning. It's not one big decision. It's just a collection of things. And then the collection of things come from things that happen around you. I'll give you an example. I thought I was pretty comfortable with everything I knew about finance until 2008. The crisis hit. I woke up every day with doubts about things that I was teaching. I was, and that forced me to think about. It was a good thing because it made me revisit the basics. As I said, I try, if I have a regret, I try to put it aside, treat it as a sunk cost, because I think regret is one of the most dangerous emotions in life and in investing in particular. Because when you have regret, it changes the actions you take going forward, often in ways it should not. So the regrets that I have don't tend to be investing regrets. It's regrets of maybe I should have spent more time with my kids. I tried, but maybe I should have tried even more, because those and more experiences. I took my son and my grandson to see the Yankees play a World Series game just a few weeks ago. Just as I took my son 20 years ago to see the Yankees play a World Series game. And guess what? I remember that 20 game from 20 years ago. That's why I took my son and my grandson. Our regrets are about experiences I did not have that I wish I could accumulate. Because those are the things you remember at 88, not the stock you bought or did not buy, or how much money you made or did not make. What is the third thing? Regret learning, and what is the
One pivotal life decision.
teaching decision? I mean, that changed my life.
Yeah.
I mean, nothing else I've done is could have altered my life path, because it's entirely possible that I'd missed that moment. I'd have gone to work for an investment bank and I would have been a terrible employee. I'd probably been fired. Who knows what the rest of my life would have looked like if I'd made that decision. So that it's without a doubt the pivotal decision in my life. I mean, you could argue that the decision to leave India in 1979 was a pivotal decision. But really, in 1979, if you wanted to kind of break out of the cocoon, you had to leave the country if you could afford it. Because India in 1979 was a very different country than India in 2024 in terms of what you could do, even if you were well-to-do, in terms of breaking out of what was already written for you. Much of your life was already pre-written for you in India in 1979. You went to work in a place where you were meant to go to work. You married the person you were asked to marry. Your life path was often written for you, and so that was not pivotal, because I really knew I had no choice but to leave that path. It'd be different today, but it wasn't then.
And you mentioned you found yourself questioning yourself during the financial crisis. What were some
Not
of the
questioning
truths that
myself, but
emerged?
questioning whether I knew what I thought I knew.
Yeah. So,
Whether I
what were
knew
some
that
of the truths that emerged for
everything,
you?
right? What is risk? Is there something that's risk free? What happens if if there's no liquidity at all? What happens if there's nobody trading? Things I thought were inconceivable
Yeah.
in a developed market happen on a daily basis. Can prices be negative? My answer before 2008, of course not. But there were things that had negative prices. That's the first time ever I've ever seen that. So almost every basic in finance, I re-examined. And it's good because much of my thinking has evolved from that relearning. Because if I'd been risen and say the market's gone crazy, and that's why I don't like to use the words bubble, shallow, crazy, unsophisticated, because basically it puts you above other people, says the market is doing stupid things. It's not my problem, it's the market's problem. That's why when I value a stock and the price goes in the opposite direction, my reaction is the market's wrong. It's not the market's wrong and I'm right. It's a question of what am I missing? My Zomato valuation at the time of its IPO reflected what I knew about the company then. My Zomato valuation today would reflect the things that have happened since. It's the nature of investing. You got to live in the market you're in, not the market you wished you were in.
Wow. That's so powerful. Coming to the last segment, onto our rapid fire. Are there any books, podcasts, or resources that have had a profound impact on your life or career?
Can I make a confession? I read very little. I read very little. I think we read too much. We think too little. Yeah.
Because you're a creator, not a
It's
consumer.
not just that I'm lazy. I don't have I have the attention span of a gnat,
I
and
find that
basically,
so hard to believe.
no, but
Someone who spent his entire life on valuation.
yeah. So I mean, you can have an attention span of a gnat and still value companies, right? I spend a lot of time doing nothing. You'd be amazed at how little I actually work. And I
How do you
describe
make
my day.
space for doing nothing?
Well, because I think we think doing nothing means nothing is happening. I mean, almost the blog post you saw on Sugar Daddies came because I was on a walk and I was thinking about these different things. In fact, I wrote about on my Damodaran board, I talked about 7 or 8 months ago opening up my email and seeing an email from somebody in Iceland. And I get thousands of email from people, many of whom are not my students, who don't even know me often about, asking about finance or valuation. He said, I'm valuing a Icelandic company, a business called Blue Lagoon. Blue Lagoon is an Icelandic spa. It's
Yeah,
been around forever, has great
I've been
EBITDA,
there. It's
grows
amazing.
amazing. And he said, I'm running into a problem. There's a volcano that's erupted and the lava is flowing in the general direction of the Blue Lagoon, and I'm not sure how to bring the lava into the valuation. I said, I've looked at books, there's no chapter on lava risk. And I didn't have an answer right then, but my dog was scratching at the door, and I said, okay, I've got to take the dog out for a walk. So I take the dog out for a walk, leaving my iPhone at home. And while I'm walking, I'm thinking about the lava problem. And while I'm thinking about the lava problem, I start thinking about this company called 23andMe. Completely unrelated thought. 23andMe is a company where you can send saliva samples and it does genetic testing on you. And it's a company that's grown a lot, but last year had a catastrophic problem. Somebody hacked into its system and got the genetic data on all 7 million of its consumers.
Yeah.
Fatal problem because the company, in a sense, imploded. So while I'm thinking about the lava flow and 23andMe, I start thinking about fossil fuel companies. You're saying, what about fossil fuel companies? Last 20 years, we've been told the existential challenge of our time is climate change. And I said, well, if that's the case and fossil fuels days on the earth are numbered, then how come you're not seeing fossil fuel stock prices collapse? How come ExxonMobil is up 23%? Saying, what do these three thoughts have in common? What they share in common is what I would call catastrophic risk. Risks that are so big that they put your survival at risk.
Yeah.
And clearly something is going on. You're saying, why aren't we incorporating that risk appropriately? And then a final thought came to mind about a movie, one of my favorite movies from a while back called Mad Max. For those of you who've seen Mad Max, it's a movie set in the apocalypse. The world has
Yeah.
collapsed. And I start thinking about during those movies, how many times I heard people in the movie talk about how their portfolios were doing. And the answer was never, right? Because in a catastrophe, survival becomes the first and only criterion. The
Yeah.
fact that your portfolio is up 30% is irrelevant because who are you going to sell the portfolio to and what are you going to do with the money? Nobody's
Yeah.
taking money. And my point was that, and my conclusion, this is 27 minutes in the walk, is as human beings, we set catastrophes aside when we do financial analysis because in the event of a catastrophe, who cares? So that's why you can pay $800 million for a building in Manhattan, even if you believe the ocean could rise 3 feet and Manhattan could be underwater.
Yeah.
And I think collectively, as investors, as analysts, we tend to put catastrophe risk to the side. And we're not being irrational. We're just saying in that event, it doesn't matter what the financial outcome looks like. And this all happened in the course of a 30-minute walk with no phone. And I think that and that's what an idle mind does, right? An
Yeah.
idle mind is not a mind that is doing nothing. It's just connecting these dots. And some of my best thinking, if you can call it best thinking, has come from having nothing to do, sitting around. I love long flights. A 16-hour flight from New York to Singapore. No, I don't know because I don't bring a lot of stuff to do. I sit there and I let my mind wander. You know, I don't read a book. I could read a book. I could, And if I feel the urge and something comes up, I can put it down on paper then and it'll grow. I've never sat down to write a book. I've written something and over time it's accumulated point where somebody says, could this become a book? And I say, sure, if you want to. My book on corporate life cycles that came out just a couple of months ago. Just a reflection of something I thought about 15 years ago. So why do companies, they seem to age like human beings. They fight aging, they do stupid things. And 15 years later, a collection of thoughts has become a book. So I read very little. The podcasts I listen to tend to be podcasts about thinking and psychology because, those are the things I'd like to know some of the ways of thinking that about what human beings do that we call irrational in economics, but are actually part of the human psyche. So there are podcasts I listen. They tend to be about psychology, about brains and how they work. If I read, it's about serial killers. I read, absolutely empty stuff about, and it's very light reading because deep reading puts me to sleep. Again, I don't have the attention span to do it. So I would love to tell you that I'm a role model, but I'm not. I'm the exact opposite of a role model. I tend to do very little. I tend to daydream a lot. And the one thing I do is when I daydream and I come up with something interesting, I put it down on paper. It's a suggestion I would make to people is when you have thoughts, put them down on paper. When you have feelings, put them down on paper. I kind of try to put them down. During the COVID year, I actually kept a weekly journal that I made into a blog post where each week I said, this is where we are, this is what I'm thinking, this is what I'm feeling. Because I wanted to record in real time what I was feeling. Because after a crisis, when you see books written,
Yeah.
you have the benefit of hindsight. You can make yourself look like a genius. I saw on March 23rd that the market was going to turn around.
Yeah.
Really? Nobody else seemed to be doing it. And the reason I wanted to do it is I wanted to be honest with myself about my fears and my doubts in real time, and then think about how do I get through those, because that's where learning comes from, is from fighting through those fears, those doubts, saying, okay, this is what I would do given where I am right now.
Love it. I think that's where your originality stems from. One professional and one personal goal over the next year.
Professional goal, I don't. I mean, I am too old to set new goals. I'm just going to keep writing and keep teaching, and if something comes out of it, great. So and in fact, that's been the pattern of my life. I've never sat down in a sabbatical because I'm going to write a new book or teach. It just happens. Personal goal, I just want to spend more time. I have two grandkids and I love them to death and they give me so much joy that I want to see more of them. So I'm going to see, try to get more time with them.
Amazing. What are you most proud of?
My kids. Yeah,
Lovely.
they're creations that'll, will have far greater staying power than any of my books or my thoughts or my writing.
Absolutely. And what's the kindest thing anyone's ever done for you?
Kindest thing anybody's ever done for me, probably allowed, when I went to teach at NYU. I mean, the head of my department said, "Just be yourself. Just go out and So, and that was kind. He could have said, "This is how we do things, and this is what you should do." So, I mean, I've been lucky enough that people are kind all the time. You just don't notice it. I just have to
Yeah.
remember to be kind in return.
I think the kindest thing you could have done was coming on the show. So thank you so much for your time today, Professor. I came with all these questions about investing and portfolio construction, but what I'm taking away are such profound life lessons from this. I think the audience will really love listening to all the life lessons that you've shared. And I really appreciate seeing this side of you and being able to showcase it to the world. It's such an honor for me. Thank you so much for being here
Thank,
today.